In price action trading, breakouts are both opportunity and danger, and one of the most common traps traders fall into is chasing a breakout that turns out to be false. These situations, known as fakeouts, occur when price appears to break through a key level, only to quickly reverse and trap traders on the wrong side. Recognizing the difference between a real breakout and a deceptive move can drastically improve your trading results and protect you from unnecessary risks. In this video, we're going to talk about breakout and why it matters. We'll explore the difference between real breakouts and fakeouts, and what causes these false moves. You'll learn how to identify a true breakout with confidence and spot key candlestick behaviors during these moments. We'll also compare retest entries versus aggressive entries to help you choose your style. After that, we'll go through real chart examples to see these setups in action. And finally, I'll share pro tips to help you avoid traps and trade smarter. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. A breakout occurs when price moves beyond a significant support or resistance level, trend line, or chart pattern boundary. Traders view breakouts as opportunities to enter early in a move. It's often seen as a signal that the current trend will continue or a new trend is starting. However, not every breakout is genuine, and that's where things get tricky. Now that we understand what a breakout is, it's essential to recognize that not all breakouts are created equal. A real breakout shows strong price momentum, often supported by rising volume and consistent follow-through. In contrast, a fakeout, or false breakout, occurs when price briefly breaks a level but then quickly reverses, trapping traders who entered too early. Recognizing this difference can be the line between profits and frustration. So why do fakeouts happen? The answer lies in market psychology and liquidity. When traders place stop-loss orders, it creates a cluster of pending orders. Also, other retail traders are waiting for breakout entries. Smart money, institutional traders, often push price beyond obvious levels to trigger retail entries and stop losses. This creates a pool of liquidity, which they use to enter trades in the opposite direction. Understanding this behavior helps you trade with the smart money instead of getting trapped by it. Spotting a true breakout isn't about reacting quickly, it's about observing the market with patience and precision. A breakout that follows a sharp, extended move, when price rushes up or down too quickly before reaching a key level, the breakout often lacks strength, as much of the momentum has already been used up. The sign of a potential breakout is a strong candlestick closing decisively beyond a key support or resistance level. This close must be clear and unambiguous, not just a temporary spike or a wick. However, price alone isn't enough. For added confirmation, always pay attention to volume. A true breakout is usually accompanied by a noticeable increase in trading volume, showing that institutional players or large participants are involved in the move. Without volume, a breakout can often be weak or short-lived. Another key factor to watch for is the price structure before the breakout. Breakouts are far more reliable when they occur after a clear consolidation phase or pattern, such as a triangle, flag, or range. This period of sideways movement represents indecision or pressure building in the market. When price finally breaks out, it signals that the market has chosen a direction, and the move is likely to have follow-through. Candlestick patterns can give crucial clues about whether a breakout is valid. For a bullish breakout, look for a strong green candle that closes near its high, showing clear buying pressure. Conversely, in bearish breakout, watch for a dominant red candle that closes near its low. In contrast, fakeouts usually involve candles with long wicks, indecision, like dojis, or a sharp reversal candle right after the breakout. Avoid trading a candle that breaks out but immediately wicks back inside, that's a common sign of a fakeout. Paying attention to these candlestick behaviors can prevent costly mistakes. When it comes to entering breakouts, you have two main options. The aggressive entry involves jumping in as the breakout candle closes, which can give better risk-reward but carries more risk. The safer choice is the retest entry, where you wait for price to return and test the breakout level before moving again. Retests offer confirmation and reduced risk, especially for newer traders. Remember, always wait for a full-bodied candle to close clearly above resistance or below support. This confirms strength and reduces the chances of a fakeout. A true breakout is often supported by a noticeable rise in volume. Higher volume shows genuine interest and participation from larger players. Breakouts that follow a tight consolidation range or pattern tend to be more reliable. These setups reflect built-up pressure ready to explode. If price races into a level too quickly, the breakout may be weak or short-lived. Momentum is often exhausted after such aggressive moves. Be cautious of breakout candles with long wicks that close back inside the range. This is a classic sign of rejection and a potential fakeout. Don't jump in late. If you miss the initial move, wait patiently for a retest of the breakout level. This often offers a safer and higher probability entry. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.